Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. Hi everyone. On today's episode, we're going to talk about what makes property such a powerful investment tool. So we're going to talk about the power of leverage in property. It's today's topic. So the best way to describe this is obviously taking you through a few examples. So I'll start off with just doing a pure equity example. So no gearing. By gearing, I mean no debt. We also call debt leverage. So those are the two words that we use interchangeably in the property market when it comes to debt. So the first example, just pure equity, and I'll show you what the returns are. Then taking a comparable example, but this time we'll add leverage, and I'll show you what the returns are in the back of leverage, and you'll be very surprised to see the difference. Then we'll go through another example of how to spread your investment over multiple properties with gearing so that you can accelerate your goals to wealth a lot quicker. Then, of course, the key to leverage is got to do with managing cash flow. So leverage can be a very powerful thing, but if you can't manage your cash flow, it can be a completely destructive thing as well. So we'll talk about that too. Before we get into those topics, let's go through the auction clearance results for the weekend ending the 16th of July, 2023. Okay, so looking at New South Wales, another strong showing, just below 72% clearance rate, so 6% up from last week. Sydney itself, just below 75%, so also 6% increase from last week, so very strong market there. Queensland, 56.5%, so basically flat to where it was last week, with Brisbane showing a slight decline with just below 60% clearance rate. South Australia seems to be moderating a little bit, so you've got just below 73% clearance rate in South Australia overall on a statewide basis. And then looking at Adelaide, you've got a 71.4% clearance, so 6% down from last week. So that's slowing a little bit. Then looking at Victoria had a 73% clearance rate, so 7% up from last week, so a strong showing. In Melbourne, 74%. At a 6% increase from last week. Right, moving into our topic. So if we had to take an example where we just invested pure equity, and by pure equity, I mean you invest your cash into an instrument and you don't use any debt on that instrument at all. Now, by instrument, it can be buying stocks or an interest-bearing account, for example. So let's just take an example of stocks. Let's say we take circa average growth rate over time on stocks. It's around maybe 9.5%. So let's just take that as an example, and we invest $100,000. So after the first year of investing $100,000, you're looking at around a $9,500 uplift in your investment. So you're left with $109,500. So simple. Right. Now, if we had to compare that same $100,000 example and we put it into property, and let's just assume with that $100,000, we were able to get 90% leverage. So you were able to get a loan for let's say we were able to get $1 million properties, put $100,000 in at 10% deposit, and then the rest in gearing, so $900,000 debt. So you purchase your $1 million property, and you have to take into account a few things. Now, all these examples are going to ignore tax just for simplicity terms. So please keep in mind this ignores tax. So if you had a $900,000 debt component, your interest and principal, assuming a 6% interest rate, which is more or less where you'd get your loans now, give or take, you're looking at around a 5,000, just short of $5,400 a month to service that debt. But if you, say, for example, purchase this property in Sydney, it's a blue chip property, you're looking at getting a net rental yield of around, for example, say 1.5%. Let's assume a property annual growth rate of 8%. So we get that 9.5% that we can compare to the stock investment. Let's look at what the mechanics of that will be. So your rental contributions will give you around, say, $1,250 a month. That's 1.5% net yield. But you owe the bank every month $5,000, just short of $5,400, which means you would have to put in additional equity every month into the investment. So we're going to include that in this calculation. So after 1 year, you would have had to have contributed around $145,600. But let's assume the property increased in value by the amount of 8%. So the property is worth $1,080,000. So if we take the property value less what's owing in debt, and that'll be around, let's say, close to $900,000, you're looking at an uplift on your equity component from $145,000 that you've contributed in equity to the equity value in your property of $191,000. So that's a $45,000 increase. Now, when you compare that to pure equity, which is just a $9,500, you can see the huge uplift that leverage gives you. But why? Why is this the case? And it's basically got to do with the base level that you're in. So in the pure equity example, you're investing $100,000, but your investment's growing at 9.5% on $100,000. However, in the property example, your investment's growing at 9.5%, equivalent of, on $1 million. So it's a much bigger base. But the trick to that is that the bank is like having another partner involved that's putting the majority of the money down. And they're only requiring a 6% return on that for that money that they're lending you. So the property is growing at 8% on $1 million. You only have to pay 6% away on $900,000. So the difference comes back to you. And that's why you're able to grow your equity portion at such a much quicker rate, because of having that cheap partner in being the bank. But why would the bank be willing to be a cheap partner? Why would he be willing to only accept 6, but the property is growing at 8%? And the reason being is that he's secured by the property. So if you can't pay him the 6%, for example, then they can just take the property and then sell the property and get their money back plus whatever's owing. So for that security, he's willing to take less of a return because it's completely securitized. Whereas you are taking equity risk in it. So if you aren't able to pay back the debt, then you basically lose what you've put into it. So that's the difference. Now, how do I judge that it's a cheap partner being in with the bank? It's all got to do what I call is the delta. So the delta is the difference between the increase in value of your property and the debt. So in this example, your property is growing at 8%. Yes, you're getting the 1.5% in rental yields, but let's just talk about the 8% component. So it's growing at 8%, but it's costing you 6%. So that delta is 2%. So you're gaining a full 2% on $900,000 every year that the property grows at that rate. So that's 2% on 900 grand, which is $900,000 that you never had. So you're earning 2% on that money. And that's why you're able to get that quick and equity uplift. So what happens if interest rates are higher than what the property grows at, its annual growth rate? Then it's a negative delta. And then your returns start to diminish because of that. So the secret is, as long as your property is growing faster than your debt component, your equity is going to accelerate substantially in the investment. Obviously, the other component to watch is inflation. So as long as your property is growing at a faster pace than inflation, then you're getting wealthier. And because you are growing on a much bigger base of $1 million as compared to $100,000 only, you're able to accelerate your growth substantially. So, easy game, right? The only challenge is making sure you're able to service the debt. So that's the trick to using gearing effectively and safely. So if you over gear yourself, then you've got the risk of basically losing the entire investment. But banks in Australia, when they give you a loan, they're regulated, and they've got to make sure that you're able to afford it. So that's why they get a lot of information about your serviceability. Now, there's something called the 2836 rule. And I'm not saying that the banks use this rule, but this is a guideline for yourself as a property investor when you get gearing, as to how much gearing you can sustain on a more comfortable basis. So the 2836 rule means that 28% of your gross annual income, it shouldn't your mortgage payment shouldn't exceed more than 28% of your gross annual income. And then your total debt that you owe, so credit cards, car, etc., shouldn't exceed 36% of gross annual income. So that's a rough guideline. The banks, depending on the bank, they have different measures whereby they check your affordability, and that percentage might differ from bank to bank. But as a general rule, the 2836 is what should apply. So you've seen the power of gearing. Now, let's just say, for example, over the years, you build up over $1 million of equity in your property. Imagine splitting that up into 10 deposits of $100,000 that enables you to purchase 5 million rand, 5 separate 1 million rand properties. So you're spreading your base over 5 million rand. $5 million. So that just shows you the power of being able to use leverage on an ongoing basis. And that just accelerates yourself, except from where prior you were on $1 million base. Now you can increase it to $2, $3, $4, $5 million base, just using 10%, 20% deposits. That's the power of gearing. All right, so that's the secret to what we call, a lot of people use in the private equity space, and that's the power of leverage. Leverage is used widely around the world in investment firms, for this very reason, because it's seen as cheap money. The trick is just being able to service it to stay in the game. Right, that's the end of this podcast. I hope you enjoyed this episode. We'll see you on the next one. Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you're interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.